Hello and welcome to our latest video. In this video, we will be discussing the SPDR Portfolio TIPS ETF, also known as SPIP. This ETF provides exposure to inflation-protected U.S. Treasury bonds, making it an attractive option for those looking to protect their portfolios against inflation. What is SPIP? SPIP is an exchange-traded fund that tracks the performance of the Bloomberg Barclays U.S. Treasury Inflation-Protected Securities (TIPS) index. This ETF holds a basket of TIPS bonds with maturities ranging from 5 to 30 years. These bonds are issued by the U.S. Treasury and provide protection against inflation by adjusting the principal value in line with changes in the Consumer Price Index (CPI). Why invest in SPIP? One of the key benefits of investing in SPIP is its ability to provide exposure to inflation-protected U.S. Treasury bonds. As we all know, inflation can erode the purchasing power of our money over time, which is why it's important to protect against it. By investing in SPIP, you can effectively hedge your portfolio against inflation risk, which can help preserve your wealth over the long term. In addition to its inflation protection benefits, SPIP also provides exposure to the U.S. Treasury bond market, which is one of the safest and most liquid bond markets in the world. The U.S. Treasury is backed by the full faith and credit of the U.S. government, making these bonds a highly secure investment option. Another benefit of investing in SPIP is its ease of use. Unlike individual TIPS bonds, which can be difficult to buy and sell, SPIP is an ETF that trades just like a stock on a stock exchange. This makes it much easier for investors to gain exposure to the TIPS market, as they can buy and sell shares of the ETF at any time during market hours. Risks associated with SPIP. While SPIP has many benefits, it is important to be aware of the risks associated with this ETF. Like all investments, SPIP is subject to market risk, which means that the value of your investment can fluctuate in response to changes in market conditions. Additionally, the value of TIPS bonds can be affected by changes in interest rates, which can impact the value of the ETF. Another risk to consider is credit risk, which is the risk that the issuer of the bonds in the ETF may default on its obligations. Although the U.S. Treasury is considered a highly creditworthy issuer, there is still a risk that the government may default on its obligations, which could negatively impact the value of the ETF. In conclusion, SPIP is a valuable investment option for those looking to protect their portfolios against inflation and gain exposure to the U.S. Treasury bond market. It provides an easy way to invest in inflation-protected bonds, and its ease of use and low cost make it a highly accessible option for investors of all sizes. However, it's important to be aware of the risks associated with this ETF, including market risk, interest rate risk, and credit risk. As with any investment, it's important to do your own research and consult with a financial advisor before making a decision.